In every market cycle, investors ask the same question, but the meaning behind it changes with time. What stocks are worth buying right now does not mean chasing what is popular. It does not mean guessing where prices will move next week or next month. It means understanding where the global economy actually is, what pressures companies are facing, and which businesses are structurally positioned to survive, compound, and grow over the next decade. In 2026, this question matters more than it has in years, because the market is no longer being lifted by cheap money, blind optimism, or emergency stimulus. Capital now has a cost. Risk now has consequences. And the gap between strong businesses and weak ones is widening. To understand what stocks are worth buying now, we first need to understand where we are in the economic cycle. Between 2020 and 2022, global governments injected more than $30 trillion into the financial system. Interest rates were pushed near zero, asset prices surged, and valuations detached from underlying cash flows. From 2022 through 2024, central banks reversed course aggressively. By late 2024, policy rates in the United States had risen from near zero to over 5%, the fastest tightening cycle in more than 40 years. By 2026, inflation has cooled compared to its peak, but it has not returned to the ultra-low levels of the previous decade. Interest rates have stabilized higher than investors were conditioned to expect, and economic growth has slowed, not collapsed, but normalized. This matters because higher rates permanently change how stocks should be evaluated. When money was cheap, companies could survive on promises. When money is expensive, only cash flows matter. In 2026, the stocks worth buying are not defined by excitement, but by resilience. They are companies that can generate real earnings, fund their own growth, protect margins, and adapt to a slower, more fragmented global economy. This is not a market for speculation. It is a market for selectivity. One of the most important distinctions investors must make in 2026 is between revenue growth and earnings quality. In the previous decade, markets rewarded companies simply for growing sales. Profitability could come later. In today's environment, later may never come. Rising interest costs, tighter credit conditions, and more cautious consumers mean that companies with weak margins are exposed. The stocks worth buying now are those with consistent operating margins, strong free cash flow, and manageable debt. Historically, during periods where real interest rates remain positive, companies with high free cash flow yields outperform the broader market by several percentage points annually. That relationship is reasserting itself. Another critical factor shaping stock selection in 2026 is capital discipline. Companies that spent the last decade aggressively expanding without regard to returns are now paying the price. By contrast, firms that restrained capital spending, focused on return on invested capital, and maintained strong balance sheets are positioned to acquire assets cheaply, repurchase shares at attractive prices, and increase dividends. Data from previous tightening cycles shows that companies with return on invested capital consistently above their weighted average cost of capital outperform during late cycle and post-tightening environments. This is not theory. It is observable across decades of market history. With that foundation, we can now talk about which types of stocks are actually worth buying in 2026. The first category is high-quality compounders. These are businesses with durable competitive advantages, predictable demand, and pricing power. They are often not the cheapest stocks on a price-to-earnings basis, but they justify their valuation through consistency. In 2026, companies that can raise prices without losing customers are exceptionally valuable. This includes firms in areas such as enterprise software with mission-critical products, healthcare companies with patented treatments, and consumer brands with deep loyalty. Historically, these companies suffer less during economic slowdowns and recover faster when growth stabilizes. The second category is essential infrastructure and services. As governments reduce emergency spending and shift toward fiscal restraint, private capital increasingly fills the gap. Utilities, energy infrastructure, logistics networks, and data centers all fall into this category. Importantly, not all infrastructure stocks are equal. The ones worth buying now are those with regulated returns, long-term contracts, and inflation-linked pricing. For example, pipeline operators with take-or-pay contracts generate stable cash flows regardless of commodity prices. Data center operators benefit from structural demand growth driven by cloud computing and artificial intelligence workloads. In 2026, infrastructure is no longer just defensive, it is strategic. A third group of stocks worth considering now are select financials, but only the right kind. In the years following the global financial crisis, banks were seen as permanently impaired. Ironically, higher interest rates have restored profitability to parts of the financial sector. Net interest margins have expanded, and well-capitalized banks with conservative lending standards are earning returns not seen in years. However, the key word here is selectivity. Institutions with excessive exposure to commercial real estate or weak underwriting standards remain vulnerable. By contrast, banks with diversified income streams, strong deposit franchises, and low non-performing loan ratios can generate steady returns. Insurance companies, particularly those able to reinvest premiums at higher yields, also stand out in 2026. Technology remains a critical sector, but the definition of tech stock has changed dramatically. In 2020, tech meant growth at any cost. In 2026, tech means efficiency, automation, and productivity. Companies enabling businesses to do more with fewer workers are benefiting from long-term demographic trends, including aging populations and labor shortages. Enterprise software firms focused on workflow automation, cybersecurity, and data management are not speculative plays. They are infrastructure for the modern economy. Meanwhile, semiconductor companies tied to real industrial demand, not just consumer electronic cycles, are positioned for sustained growth. Artificial intelligence is real, but its benefits are unevenly distributed. The stocks worth buying are not necessarily those developing the most advanced models, but those selling tools and hardware that every company must use. Another important category in 2026 is healthcare, particularly companies addressing structural demand rather than discretionary spending. Aging populations in developed economies are not a forecast, they are a certainty. Healthcare spending as a percentage of GDP continues to rise, regardless of economic cycles. Pharmaceutical companies with diversified pipelines, medical device manufacturers with recurring revenue, and healthcare service providers with scale advantages are all positioned to benefit. Historically, healthcare stocks have delivered strong risk-adjusted returns during periods of slower economic growth, and 2026 fits that pattern. At the same time, there are categories investors should approach with caution. Highly leveraged companies are far more vulnerable than they were 5 years ago. Rising refinancing costs can turn modest slowdowns into existential threats. Businesses dependent on discretionary consumer spending, particularly those without pricing power, face margin pressure as households prioritize essentials. Speculative growth stocks that rely on capital markets rather than internal cash generation remain risky. The lesson of the past decade is not that growth is bad, but that growth without profitability is fragile. Geography also matters in 2026. While global diversification remains important, investors must recognize that different regions are at different stages of the cycle. The United States remains relatively resilient, supported by innovation, energy independence, and flexible labor markets. Europe faces slower growth and structural challenges, but select exporters and industrial leaders remain attractive. Emerging markets present both opportunity and risk. Countries with improving fiscal discipline, stable currencies, and domestic demand growth offer long-term potential, while those with political instability or heavy dollar-denominated debt remain exposed. Stock selection matters far more than country labels. Valuation cannot be ignored. Even the best business can be a poor investment if purchased at the wrong price. In 2026, valuation discipline is essential. Stocks worth buying are those offering a reasonable balance between growth, cash flow, and price. Historically, periods following rate normalization reward investors who focus on earnings yield, free cash flow yield, and balance sheet strength rather than optimistic growth projections. This does not mean avoiding growth. It means paying a rational price for it. Another overlooked factor is dividends and shareholder returns. In an environment where capital gains are less predictable, cash return to shareholders matters more. Companies with sustainable dividend payout ratios, consistent dividend growth, and opportunistic share buybacks offer tangible returns even when markets are volatile. Data shows that over long periods, a significant portion of total equity returns comes from dividends, particularly during sideways or low-growth markets. In 2026, income is not boring. It is strategic. Ultimately, the stocks worth buying right now are not defined by headlines. They are defined by fundamentals. They are businesses that can survive without constant access to cheap capital, adapt to economic shifts, and reward shareholders through real earnings. This is not a market for guessing. It is a market for understanding. As we move further into 2026, the most successful investors will not be those who predict the next rally or correction. They will be those who own high-quality businesses, bought at sensible prices, and held with patience. Market cycles will continue. Volatility will return again and again, but value creation remains consistent. Companies that generate cash, manage risk, and serve real needs endure. Those are the stocks worth buying now, not because of hype, but because of logic, evidence, and history. And that is the real answer to the question investors keep asking. Not what will go up tomorrow, but what will still matter years from now.